Hey, I'm Matt, and thanks for watching Matt Talks Mortgage, where we talk about anything and everything to help get you prepared to purchase or refinance. So today we're going to talk about a topic that is coming up more and more these days, which is how can I get approved for a mortgage, whether I'm buying a house or refinancing if I am self-employed. So a lot of my clients used to be W-2 employees. They since switched to contract work, and they're not sure how that affects them when it comes to buying a house or getting qualified for a refinance. Again, just like most of my answers, the short answer is going to be yes. If you are self-employed, you can qualify for a mortgage, whether that's buying a house or refinancing. It's just going to look a little bit different than if you're W-2. So let's go ahead and break down what that looks like. If you've purchased a home before and used a traditional loan program like conventional FHA loans, VA loans, right? If you're a veteran, or using a USDA loan, they all allow self-employed buyers. And a few of the things that they're going to want to see are usually 2 years of tax returns, where they're going to calculate not how much money your business received, but how much money you've reported to the IRS as taxable income. And therein lies the problem with a lot of our self-employed clients. Of course, their CPA, their tax preparer, or themselves, you want to show as little taxable income as possible to pay less taxes to the IRS. Who wouldn't? The only problem with that is when it comes time to qualify for a mortgage, we're not using the higher number of what your business made. We're using the smaller number of what you reported to the IRS as taxable income. Because remember, these are loan programs that the government put the guidelines in place for it. If the government put them in place, well, then the government wants to use your taxable income. So they're going to look at 2 years of tax returns, both personal and then if you have business returns. Sometimes they're going to want to see a profit and loss statement for your year-to-date income. And sometimes they'll even ask your CPA to write a letter just verifying a few details about how you file and how long you've been in business. So if you've run into some of the hurdles I just mentioned, meaning maybe you've had multiple self-employed jobs or self-employed income, 1099 income, and you're just not showing enough stability, enough taxable income, the good news is there are solutions for self-employed people like you. You just need to find the right loan program and the right mortgage advisor to put together and structure a mortgage that aligns with how your business runs. Now, me and my team, we are mortgage brokers. So what that means is we're able to shop hundreds of lenders to find a combination of the best loan program, the best service. So once you actually do find a house or refinance, we know the process is going to go smoothly, and loan options. We have access to specific loan programs designed for you, a self-employed individual. So we're going to go over a couple of those and we can find out which one might be the best fit for you. Now, because many of my clients are self-employed, I would say the most popular one among all of them is going to be the bank statement loan program. Now, this is an alternative loan program, and they're going to look at the last 12 to 24 months of your bank statements. And what they're going to do is they're going to average all of your business deposits over that 12 or 24 month period. And then they're going to subtract a certain percentage for operating expenses. Now, this varies for every type of business, because if you're an IT professional and you're a consultant and maybe you just work out of your house and you're the only employee, your operating expense might be 10% or less. If you own a restaurant, it might be a lot higher. If you've got 10 or 20 employees, it could be even more than that. So what they're going to do is average out those deposits. We're going to see what your operating expense is, and we're going to subtract that, and that's going to be your qualifying income. So as you can see, let's say you've deposited $150,000 worth of business deposits every year. Well, maybe on your taxes, you showed that you only walked away with $30,000. Well, now those business bank statements now over double the income that we can use to qualify. I'd say the second most common program that we use is called asset utilization. Let's say that you've been self-employed for a long time, let's say 20 years. And after 20 years, you're starting to wind down your business a little bit. However, you've accumulated a lot of assets in CDs, retirement accounts, Roth IRAs, investment accounts, checking and saving. These lenders allow us to add up all of those assets that you have available to you. We're allowed to use a certain percentage of them. And then what's going to happen is they're going to subtract a certain percentage, usually because some of these accounts, like an investment account or a retirement account, if you're not of retirement age, usually requires you to pay some sort of taxes on it. So you may not have 100% access to 100% of the funds. However, if we're no longer showing income on paper, or even the self-employed income that you're getting is relatively low compared to the amount of assets you have, this could be a great alternative to get you qualified. And what we're seeing right now is interest rates are relatively comparable to where you'd see on traditional loan programs. And then lastly, I would say the third option that a lot of our self-employed clients and even investors use is called a DSCR loan. So this stands for Debt Service Coverage Ratio Loan. And this is used for people buying investment properties. Now, many of our investors are self-employed, and the amount of paperwork that they have to show us to get qualified for a traditional loan is just crazy. It could be a headache. They're busy. They don't want to provide 2 years of tax returns and bank statements for every single house and mortgage statements for every house and insurance documents for every house. So as you could see, that document stack piles up pretty quickly. And a DSCR loan is going to allow you to purchase the house with no income. Now, really the only thing they're going to look at to qualify is, do you have a good credit score? Do you currently own a house? So this can't be for a first-time home buyer. And do you have enough money for at least a 20% down payment? And you've got maybe 3 to 6 months of reserves in the bank. Now, if you have all three of those, and then finally, typically they're going to want to see that the average rent in that area covers the mortgage payment. Now, some of our investors even allow for a no ratio loan, meaning maybe you're looking for a short-term rental with an Airbnb and there's not enough data on it yet. They'll still allow you to purchase it as long as we qualify in all of those other areas. Now, this is great if you're purchasing multiple investment properties and you have the funds for a larger down payment and a great credit score. This is the one you probably want to look at. So even though there's a lot of flexible loan programs out there for self-employed buyers, it doesn't mean that we don't want to set ourselves up for success. So here's a few things you can do. So for instance, one, you're going to want to make sure, if possible, to keep your business deposits separate from your personal deposits. So have a business bank statement. If we're doing a bank statement loan program, it helps them to be able to determine what's a business deposit versus what is a personal deposit if you have two separate bank accounts. You're also going to want to make those deposits consistent if possible. So if money's coming into your personal account and maybe you're holding on to that money for several months and then dump it into a business bank statement, maybe consider doing that on a monthly basis. Also, I would check with your CPA. You'd be surprised how many times when you speak with your CPA, you'll find out that if you show just a little bit more taxable income, you'll actually qualify for a traditional loan program, and it may not affect you as much as you think when it comes to file your taxes. And then lastly, I would set some reserves aside, maybe anywhere from 3 to 6 months. Now, it's not always required, but it definitely doesn't hurt, and in some cases, can even be the defining factor between qualifying and not qualifying. So again, can you get a mortgage here in DFW if you're self-employed? And the answer is absolutely. The defining factor is going to be connecting with a mortgage advisor who can look at your situation and help you find the best alternative loan program to fit your situation and meet your long-term and short-term financial goals. Go ahead and send me an email, give me a phone call, shoot me a text message at the number below. Happy to set up a time to review your situation and really just give any guidance I can on what the next best step is.